Welcome to another episode with Loans Elevated. My name is Broch Lassig, top 1% loan officer nationwide.
And I'm TJ Heidenreich. Together we bring the latest news, strategies, and insights in the mortgage and real estate industry.
So that brings us into the next thing. So we covered Fed, inflation, last is recession. So recession, we found, usually follows the first tick up on the unemployment rate. Now everyone's like, whoa, what are you talking about? I see a bunch of reports that the employment's the best it's been in years, all-time highs. Well,
very politically charged reports and stuff we hear. It's like at record lows, historic lows.
That's on that.
That's a scary sign.
For sure. So every recession we've been in the past, the first tick up from the low of the unemployment rate leads us into recession. So this is a super zoomed in.
Bounce back. Let's just show that here on the slide. The horizontal gray lines are recessions, and the blue line is the unemployment rate. So what you notice is, like, even go back clear to like the late 70s, you see a tick up. Very shortly after we see inflation. We see a tick up here and instantly we're in a recession. Tick up here, recession. Tick up here, recession. Tick up here, recession. I mean, obviously COVID, recession.
So, it's important to know it's from the lowest point that we've seen.
From the new
because we see here, this is just over the past year or so, we've seen a couple ticks up, but it hasn't been from a low. Like at the time they were lows, but now we're at a new all-time low.
And we've ticked up as of the most recent report.
So that's the first sign, leading indicator of a recession. Next, Broch loves this. It's the yield curve. We've heard about the yield curve last year. Was a very common theme when the 10 and 2 year go inverted. That's usually a leading indicator that a recession is going to hit, and it's been inverted for almost the past year. But now it's steepening. Dive into what that actually means.
Did you all hear about that? Like, every person in our industry was like, oh my gosh, yield curve inversion, we're heading to a recession. Did you guys hear that?
And be honest, who even knows what the hell yield curve means?
Does anybody know?
Cool, perfect. Dive into what it actually means, because everyone was saying it, they didn't know what they were saying.
Yeah.
Like, honestly, go ahead.
So the yield curve is basically the treasury bonds showing, like, there should be a natural curve up and to the right, because the longer you invest your money, the more return you generally expect. That's what should naturally happen in the yield curve. What had happened is that it had gotten inverted. So the shorter investment was paying more money than the longer term investment, all the way down to like a 1 year versus a 30-year bond. So you invest your money for 30 years, you make less money than if you invest your money for 1 year. That's like insane.
It's so backwards.
It is, but it's a sign that the financial markets sniff something, right?
The investors are uncertain of the future, long-term future, so they're scared. They're
exactly. So they're demanding higher returns today because they still need time to assess what's happening in the future. But there was a lot of argument like this. I mean, it was like the biggest thing in our industry. Maybe we were just more attuned to it, but for like a year. And the biggest argument was like, okay, well, the yield curve inverts. And what you notice is below this black line is that's like an inversion. This means the yield curve is negative, which is inverted. There's no like real sign of, I mean, it always eventually leads to a recession. You notice the gray bars, but there's no like time horizon. It's like, when does it? It happened twice here, and then finally a recession came. So the argument was like, is there actually going to be a recession with this yield curve inversion? Because there's no real rhyme to the madness. But what there is, which we identified just recently, is when the yield curve steepens or flattens. So when things start to normalize is when you definitely hit a recession. And if you notice, as soon as you see this steepening, so basically steepening up this way instead of coming down here, every single time is right at the beginning of a recession or months leading up to a recession, steepening. And look at what we have right now. It hasn't been called yet, but historically this would say that we're probably in a recession right now, and it will somehow overlap or land like somewhere about right here is when that recession will come. Move on to the next slide.
And the Fed, when we call for recession, we can be in a recession already. They can backdate a recession, so we could be.
They always do.
Yeah, we could be in the midst of a recession right now.
Yeah.
So, I mean, that doesn't mean we should worry though if we're in a recession. And we've probably all seen this graph before, but I pulled it out just yesterday with a client in a consultation, and it totally flipped the script on what they thought about housing. So
because the media is freaking everybody out about
the media's talking about recessions, and it's like doom and gloom. They talk about the Great Recession because that's what everyone falls back onto, and that home prices are just going to plummet. So recessions in the past, every single time, this line right here, this faint gray line, that's home prices. It's always gone up or stayed flat.
With the exception of 2008.
Exactly.
But forget about that. That's nothing the same.
Exactly.
Nothing's the same as it was back then.
For sure. And then the blue line, that's mortgage rates. You notice something weird about this? There's no correlation between mortgage rates and house prices. Even here, as mortgage rates have spiked, so do house prices. It's crazy how they don't follow each other at all.
So this slide, in my opinion, is like the epitome of our title, which is facts, not fear, because they are being just annihilated with fear. Our clients, so are we, right? It's scary. We have to have these conversations among ourselves in the team constantly, making sure that we believe what we're telling our clients, right? Because that's probably the most important thing. That is like the epitome of it. Everyone's afraid that it's just 2008 again. We need to understand, like, does everyone understand? I don't want to bore you with lame details. By show of hands, who doesn't understand why this is very different than 2008?
Sweet.
Everybody understands. Okay, sweet. So we can explain that to our clients and then show them that graph. We could share this graph with you. That pretty much eliminates all the fear, because it's like, who cares? Rates for sure come down historically every single time during a recession. Home prices go up. Like, what are we worried about? What we're worried about is that headline you saw in the news, and you failed to read the whole report, right? That's what they're worried about. So
for sure. So, but the crazy part is the fact that our clients need to know is they should be afraid, but they're afraid for the wrong reasons. If it's simple supply and demand, and you guys are all agents, you understand. Like, you look at the active listings right now. It's scary how low we're at for the time of year that we're at right now, and it's not going to get any better. We're 31,000 units short, and that's from James Wood from Kempsey Gardner of units that we should have to house all the formations we need.
One thing we didn't actually put that in the slide. One thing I like to talk about is we're still 31,000 units short. That was as of 2021, which is when that report was published. So 2022 may have made a dent, but from 2007 to that report in 2021, we only closed a gap of 26,000. So before it was 57,000 units short, and from 07 to 2021, we only eliminated 26,000 of that shortage. So I mean, that's a lot of years for us to eliminate more than what was eliminated over that time. And some of these points kind of highlight this, but builders are slowing down. Like, there is reluctance and a lack of confidence in building in a pretty big way now. So it's
builder sentiment is at an all-time low right now. And I mean, that leads to, like, you guys I'm sure we've heard about the bill SB 240. I like to call it 270 because it's not 270. It makes Brock mad. But SB 240, we think that's for first-time home buyers to get them to buy. It's not for first-time home buyers. It's for builders, because government recognizes, hey, crap, there is not enough inventory. We need to get some more buildings up so we can sustain, like, so we can catch up with.
So we don't have 25% appreciation.
Yeah, and for sure.
Become LA.
That's not healthy.
Does everybody know what that is? Is that 20 million?
I don't know the total amount of funds.
Ryan, you looked this up. Well, it was more than that, wasn't it? The amount in the SB 240 bill that will be recycled? 50 million. Yeah, 50 million bucks.
Are being offered to buyers to buy new construction. Your lenders can provide, these guys can provide you that. Think about that, $20,000 going in as a down payment on a new build.
Down payment, closing costs, buy the rate down, anything.
It's a pretty amazing bill.
Yeah,
sure.
It is.
Goes into effect
July 1st. Yeah, more details to come. Yeah.
Yeah, I guess we'll see. Yeah. SB 240.
Yep. Sweet. So that doesn't even take into effect the amount of people that are coming into Utah. So we're expecting 35,000 people to come into Utah.
No, that's what we've seen.
No, excuse me. That's what we've seen.
I think it's going to get worse.
Yeah, exactly. The average household is about 3.5 people per household. So that's about 10,000 new households in Utah this last year. So, but that doesn't also take into account the amount of people coming of age to buy. The average is 27 to 33-year-olds. We've seen another 19,000 people, and then rates coming down.
19,000 in Utah, based on the population in Utah and their ages. 19,000 per year becoming new homebuyers, new households that are required.
Correct. And then every time the rates come down by 1%, that is 5 million more people that can afford to buy nationally. Well, Utah, we're like 1% of that national population number. So that's about additional 50,000 people that can afford to buy when rates come down, which we're expecting later on this year. So in 1 year's time, that's almost 80,000 people in the housing market that were not in the housing market before. With all-time low inventory. Like, that gets scary. We're turning back into, like we said before, deja vu in a market where it's bidding war after bidding war. There's not enough houses for what we need.
And like we said, year over year, 21 to 22, building permits went down 20%. I think it's only gotten worse since then with builders. And inventory levels keep, I mean, you guys all know this, inventory levels keep going down. I don't know what is on the MLS right now. Is it under 6,000 now? 6,500? Yeah, I mean, it's scary stuff. That came, we were just barely at like nearly 12,000, right?
October?
11,000,
I think it was like 12,000 October.
Yeah, it's crazy.
Yeah. So some numbers here that the most homes that have ever been built in the U.S. were 2 million homes. We would have to build 2 million homes plus an additional 20% every year for 5 years to catch up to the amount of homes
just
needed.
to close the
Just to
shortage
close the
gap, the current shortage gap. Not accounting for, and there's some other data too that we could share with you with the millennials coming of age, and it's birth rates that were 33 years ago, and how many people were born 33 years ago. Moving forward over to the next like 5 to 10 years are the highest rates of people coming of home buying age ever in history. So like this just amplifies and keeps getting worse. And in Utah, I think even worse, like right with the Point Project and the Inland Port and these things that are coming, making Utah more of a big boy place to be. Like years ago, I'm sure you guys traveled for business conferences. No one even knew what they're like, Utah, how many wives do you have? Like it was a stupid joke. No one liked
you have horns?
Utah, right?
Are you Mormon?
Yeah, it was like crazy. Now it's like the place. I hear about like so many young people want to move here because the lifestyle and all that stuff. Like we got issues, and this is stuff our people need to know that have the opportunity right now to buy and are choosing to sit on the fence because, oh my gosh, home prices might go down next month. And oh my gosh, mortgage rates are too high. It's like, dude, we need to find a way to solve this. Otherwise, you won't live here with your family anymore. Or if you do, you're going to live in like Salem or Nephi or something, and your family lives right here in Salt Lake, right? I mean, it's like, it's a real issue. And this is the fear the clients need to have, not the BS media fear. So, and by the way, we can get this report for you guys based on any county or even a zip code. We can get a report, and it's way more in depth than this. Talks about a ton of demographics. We can get this for you. So if you want it, just hit one of us up, whoever invited you, and we can get it for you.
Yeah, for sure. So, like Broch stated before, with rates coming down, that doesn't mean it's going to be a straight line. There's going to be some bumps in the road. We're going to get a few inflation reports that are not going to be in our favor, and we know it's coming. We've seen data to show it's coming.
Well, the reality is we've already experienced it. Right. And what happened? Rates ticked up. Oh my gosh, inflation was up. Some news report comes out, and it's something negative about house prices. What did our buyers do that were active? They're like, oh gosh, I don't know. You know what? We're going to wait it out another month. It's the worst decision they could. It's literally a matter of not life or death, but it's a matter of like rich or poor.
Yeah.
Or live in Utah or not. It's a really big deal. So we need to understand these opportunities that are presenting themselves.
So the first opportunity that's coming up is just in a couple weeks. The second Tuesday of April, we're going to get an inflation report that's not going to be in our favor because the way that the CPI works is it's replacing numbers from last year's CPI report. So last year's CPI report, it's replacing March of last year. It was a fairly low number from the broad spectrum of all last year.
We're showing you here.
Yeah, yep,
It was
just right
only
here.
up 0.3% month
Yep,
over month.
exactly. So we might be above that. We might be right on par with that, but it's not going to look as good as we've seen previous ones. So it's going to scare the markets. We might see rates tick up, and buyers that are on the fence, they're like, nope, we're not buying. But our buyers that we're talking to, we're like, hey, we're telling them about this opportunity that's coming up. Yeah, you might have a higher rate. Well, that's why at CrossCountry, like we're offering, there's a free refinance for up to 3 years after, because we know it's more important to get in the house with an opportunity where you can get seller concessions.
Yeah, we're putting our money where our mouth is. Like we're not just telling them buy for no reason.
Right.
We sincerely want them to buy so that they have an opportunity to own a house and create wealth long term. And it's an important thing. But understanding these headwinds and like being able to speak to it even before it happens, or warn your clients of it before it happens, so that when it happens, they're like, oh crap, Broch said that, and maybe I shouldn't go back on the fence and be worried and not buy. Yeah, Dailies.
Anybody talking about the free refinance for the next 3 years?
Okay, well now everybody knows. Well, we suck. Okay, so you get a free refi.
Any mortgage that closes before July 1st of this year, free refinance for up to 3 years.
Take that July 1st with a grain of salt because it was April 1st and then we extended it to July 1st. So we can only do it in 3-month increments. Yeah. But we're basically giving them a free refi in the first 3 years after they close a mortgage with CrossCountry, if they refi with us, of course, right? So. Yeah, any type, not a construction loan, but that's a much different story. But any type of loan besides that.
For sure.
Okay, that's good to know.
Sweet.
Yeah, thank you for bringing that up.
Yeah. And there's another small window in August. The window might have been closed by then because it's summertime.
Well,
And
and because you see
Look at
these
this.
comparisons.
Yeah, exactly.
Like
Rates
inflation could be way
I mean, no crystal ball here, but rates could be we could be in the 5s by that point. So it could be
easy. And it depends on how, if we see a recession, if this bank crisis gets worse, there's a lot of ifs that could happen in that duration. I mean, if we dive into a deep recession, like all bets are off, but rates are going to be down. We're probably going to have more unemployed clients, but there will be a massive opportunity for
definitely
people through that recession.
Go ahead.
Okay, so just to simplify, that was a ton of data. We want to leave room for Q&A and maybe some back and forth conversation that hopefully we can pull more out of this, but to distill down to the basics, like what do we need to understand? One, the media is and will lead your clients astray 100% of the time. It's their job. It's what they get paid for, okay? We need to be the information resource. So we need to understand it and be able to confidently portray this to our clients so they trust us to, like if they get the fear from the media-driven headline, they'll call us and say, man, I saw this. What does this mean? Like what are the details behind this? We need to become that resource or the local real estate economist, which again, we're going to be having that class again soon. Mortgage rates follow inflation. It's not the Fed rates. If the Fed drops, I mean, I remember when COVID hit, Fed dropped rates to 0 and I got like 15 text messages in an hour. It's like, dude, I got a refi. Rates are at 0. I'm like, oh, no, they're not. You know, I wish they were, but they don't follow Fed funds. They follow inflation. In other words, Fed rates do not control mortgage rates, so clients don't need to panic about it, or they shouldn't get overly excited about it either. Recessions equal lower mortgage rates, but not lower home prices. And housing prices are supported by systemic supply and demand issues. So if our clients think rates are going to be high forever and it's unaffordable, I hate to say it, but they're wrong. If they are afraid that home prices are going to go down, they're wrong. And that's supported by so many things. And the supply and demand issue is a really, really, really big deal. So these are the big highlights that we think that's what it all means and what you guys need to understand.
Yeah. Before our Q&A and just back and forth, if you guys aren't doing so, please follow us at Loans
Will
Elevated.
everyone just pull their phones out and follow us on social media right now at Loans Elevated?
A lot of this information we put out all day. I mean, every single day of the week that we're putting information out that we're researching. We've got a research day where all of our team, we're head in the laptops researching data because we want to make sure that we're giving our clients the accurate information.
And the beauty is it's always in bite-sized pieces, not a big giant presentation, and it's very relevant. It's like stuff that happened on Friday is being released on Monday or Tuesday. So it's a good resource for you guys to help with your clients. And you can share our data. Like we can tell the story to your clients for you if you share our stuff. So
for sure. And then second, please scan this QR code. If you haven't already, pull out phones and scan this QR code because we want to know what you guys want to learn about. If there's something in the industry you guys are struggling with or something we can help cover, let us know and we'll make that a class.
And then in addition on that survey is a referral of a realtor you guys know that would find value in attending something like this. Give us their info too if you're willing. And if I guess tell us in the comments if you want us to keep it discreet that you shared their info. We won't tell them. Okay,
for sure.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.